So you're great at sales, great with customers, hustle hard, but when it comes to the numbers, you hit a roadblock. And it's not your fault. No one teaches this stuff when you start a business. You're just expected to somehow know how to read a profit and loss, interpret a tax return, lodge a BAS, manage your cash flow, and forecast growth, all while running the actual business. So in this deep dive on business financial literacy, I will cover how to read a profit and loss statement, how tax fits into the bigger picture, how to use your financials to make smarter decisions, and how to differentiate between cash flow and profit. Ready to dive in? Before we get into the video, I want to talk about today's sponsor, Xero. Xero has been my go-to cloud accounting software for the last 18 years because it's been the easiest to use and has the best functions to suit most small businesses. Not only do I use Xero for my own business, but I recommend it to all of my clients for this very reason. Having reliable cloud-based accounting software like Xero can also help you easily track your income and expenses at any time. And being able to generate custom reports can help you get a better idea of how your business is performing so that you can make smarter business decisions. So if you haven't decided which accounting software you'll use or you're looking to upgrade from your current one, I highly recommend you try Xero. Scan this code to access a special offer I've arranged just for you, my YouTube audience. You can also find it in the description box below. Now, back to the video. All right, so why does financial literacy matter? Financial literacy matters because you, as a business owner, make decisions. And these decisions every day could be about investing in a property, could be about employing an employee, and it could be about taking on a client and thinking that you can afford to pay for the expenses for the client and then wait for the money to come in. Those heavy and hard decisions that you make would affect your business and could actually bring the downfall of your business. For example, if you go and buy an investment property and you take the money out of the company and you invest it, then you've forgotten to pay the taxes because you haven't looked at your numbers. Another example is you might employ an employee thinking that you can afford it, not realizing that superannuation, payroll tax, wages tax, and insurances that then push your business up to a certain point where it's negative cash flow. And it usually takes a bit of time for your employee to, get onboarded and get ready to start making you money. So they are the things that you need to understand when you read your numbers. And lastly, obviously, when you're making a decision taking on a client, and this is actually very crucial for a lot of builders, is that when you do a build, you need to know your numbers because the build itself could be $1 million and $2 million. And you don't have $1 million in your bank account to fork up to pay for the materials, the subbies, to do the work. So you need to make sure that your installments that you're charging your customer can be used to be and put you in the cash flow positive to be able to do the project. And that's why a lot of builders go under. It's not because with some of it obviously is rising material costs and all that stuff like that and red tape, but a lot of it is to do with they just not managing their cash flow well, not charging the right amount. Yeah, and then as a result, they're actually not making money by the end of the day. And that's what causes the problem. And I see it so many times. And that happens to many businesses, not just construction. Cool. All right. So let me know if you have any questions, but I'm going to start off with sharing my screen. Okay. So this is a profit and loss that I didn't upload it into ChatGPT. I just asked ChatGPT to produce me a P&L for a recruitment company that's been in business for about 2 to 3 years. And it's produced me a profit and loss. So this company here, this is the financial statements. So there's a profit and loss, and there's also something called a balance sheet. So profit and loss is what its name is. It's basically shows you the profit or the loss that you've made during the year. And usually during the year, it's 1st of July to the 30th of June. And that's because the financial year that we're in. It's basically the statement that shows how much money you've made at the end of the day, or how much money you've actually have made a loss of. So how much losses you've made throughout the year. The main thing you need to understand is there are basically 4 components of it. It's revenue, which is sales and income, and then cost of sales. So cost of sales is basically any expense that's directly related to you making that $1 or making that dollar. So basically because you got to understand the nature of your industry. So if you're a recruitment services and you're charging a fee to find a employee for one of your clients, what you need to do, what your expenses would be that directly relates to you making that $1 is background checks, for example, and job ad posts. So for every job that's available, you will probably spend, $50, maybe, no, sorry, not $50, like $500 of job ad posting. So these expenses are directly related to this. If you have zero clients and you don't have any positions to recruit for, then most likely these will be $0 as well. So that's the difference between cost of sales, which is the expense directly related to your sale, versus like operating expenses. Okay, that's where you have to know the key difference. It's actually really important to know this, because sometimes you look at this and then you go, you start looking at the ratio. So you go, there's something called a gross profit margin. And this is very important for some of you guys that run e-commerce businesses, for example. So a gross profit margin is basically your gross profit, which is this amount here, which is revenue minus cost of sales divided by your total turnover. And so this is currently at 70%. So basically every dollar that you're bringing in, you're only spending about 27.5% to make that dollar. Okay, so every dollar that you're spending you're only spending 27 cents to make that dollar. And that there is a good business. If your gross profit margin is say 50%, that means that every dollar you're bringing in, you're spending 50% of that dollar, 50 cents to actually make that dollar. And it's actually hard work. That means that you can't really spend a lot of money to operate your business. And it's I don't know who created this, but I realized that it's actually a good thing to actually understand. Because here, if you do the analysis when you first start your business and you see that this is usually, more than 50 to 60%, and there's no way for you to be able to drop this, then it's something that you need to consider before even starting the business. Obviously, when you first start the business, it does look not the best. So sometimes you may spend more money doing job ads and background checks. And the reason being is because you might suck at your job, or you're trying to figure out how to do better. And so you're spending a bit extra because these job ads are lasting longer. These background checks you have to do a few times because you've done them wrong. And also the contractors that you're spending money on may not be the right ones, like right people to spend on. So you end up spending a bit more as a result. And this happens with e-commerce as well. You might have been buying, $420,000 selling $420,000. But when you sell $1 million worth of stock or sales, that means you get economies of scale. You get a bigger discount when it comes to your suppliers. So as a result, it's actually it's okay if your gross profit margin is smaller, but you have a plan for it to be higher over the long term because of economies of scales. And economies of scale is basically, it's a term meaning that the more you enlarge the activity that you're doing, so the more you scale, the lower the cost is, and as a result, the more profit that you make, or the more efficiency you produce in whatever you do. Cool. So that's revenue and that's cost of sales. And the whole point of this is to work out if you're making money at the end of the day. So obviously you need to add in the operating expenses. So operating expenses could be fixed costs, could be variable, doesn't have to be one figure every single year, but you will most likely have to pay for wages for, admin staff or the director. You also have to pay for rent, marketing, software. And in this case, for a recruitment service business, these are the expenses they pay. Okay. Like I said before, e-commerce businesses will have a lot more. You can determine how you want this to look because you're the one that puts this in Xero. Okay. So you could actually make this look a lot more bigger. Like you can have the profit and loss be like 2 pages. And how you change that is through something called a chart of account. So in Xero, or the accounting software that you have, there's a section where you can actually go on to the chart of accounts. And basically a chart of accounts is a fancy word, but really what it is just a classification of your types of income, the type of expenses, as well as even your assets, like the assets that you purchase in the business and the liabilities. And I'll go into more detail about assets and liabilities in when I talk about balance sheets. But this P&L, you can build onto it even more. Some people would prefer not just to look at recruitment service fees. They might want another account, and they can create another account and then call it recruitment service fees for international jobs. And then they want another one for international, for domestic, which is like Australia. So they might be like working overseas and they just want to track the sales they're making on international jobs and Australia. It could be for e-commerce, similar case. It's up to you. So for me, when I run my business, I actually have probably about 10 of these revenue items. And I go into detail of, annual businesses, so business services, tax advice, company setups. So I just track all of those. Commissions, if I have any commissions. And I just want to see which one, the reason why I want to track all of them is because I want to see which one actually makes me the most amount of money versus the amount of expenses I actually spent. Then I can determine later on down the track, which one should I focus on more. Okay, so for the mortgage brokers out there, you might have commercial asset finance as a line item, which is more for businesses, and then resi commissions or resi's income, which then you can track which one is actually doing better. If you see that commercial is small, but you spend less time and it actually makes you more money and you can see it trend as if it's growing every month, then that's where you go, all right, I need to focus on that. Because that's actually where the gold mine is. And I'm going to make a lot more money eventually on the long run. But you can't see it because you just see $600,000 as a whole if it's grouped together. So that's the importance of looking at the profit and loss and determining how you want to split this up. Don't just rely on your accountant because your accountant doesn't really care. Okay? What your accountant's job in the end is not just to tell you how to run your business. It's actually to tell you how much tax you're supposed to pay, how to get your financing. And that's like the external, but also the main goal for you overall. But how you make that extra dollar is most likely, an internal accountant's job or you as a client. Oh, I've got a question. Okay, so would costs of sales include internal costs that may be incurred, such as house time spent on a proposal or tender response? Yeah, that's a good question. So basically, just to explain, that's and my differentiation of what you're talking about is like, you do consulting. And so as a result that you're spending a bit of time trying to tender for a job or prepare a proposal for a job. And you might do like preliminary work. The preliminary work and the tendering for a job is actually covered in salaries and wages for usually admin staff, right? Because if you were to outsource that, like eventually when your business grows into like your business could be up to this point right now, but say like you're at 10, 15 mil, you probably won't be focusing on preparing those documents and preparing for the tender. You'll have people doing that. And as a result, it's actually covered in like overhead costs, which is operating expenses. And that's like, salaries and wages. Because the more people it's more the actual cost that would directly relate to an extra dollar that you're making, for example. So in this case, recruitment, it's just job ads. If you post more job ads for jobs, you're going to get more candidates. And as a result, you're probably going to make more money. Yeah. So you wouldn't be putting a job ad out if you didn't have any clients. Yeah. So the tender job, I guess you can argue the same thing. You wouldn't be doing a tender job for a tender or preliminary work without without any clients. But I guess in this case, it's kind of indirectly related, whereas this one is completely directly related. And I think the best example is like when it comes to e-commerce. If you buy a material or a supply, when you sell it, you're going to sell it for 3 times more. You buy one for like, say, $3, you'll sell it for like $10. And that there is cost of sales. That's how cost of sales is. If you're not sure about it, don't worry too much. An accountant can help you out with this. But your wages is usually covered most of the time as a director or owner of a business, it's usually covered in operating expenses. And that's where I put it. Unless you're an accountant and you're doing accounting work, and the director himself is only doing accounting work, he's not managing a business, then you put the accounting service expenses as cost of sales, which is what we do in our profit and loss. Okay, that makes sense? Hopefully I answered it, Andrew, but it's a bit confusing sometimes. But what you're doing is actually admin work when you're tendering for a job, so therefore it should be in salaries and wages. But if you're actually doing principal work, they call it, where you're doing the work for the service you're providing, for example, which is accounting. If I'm an accountant and I'm doing tax returns, then really I should be in cost of sales. Yeah, my wages. Yeah, but my job has changed over time, so now it's more actually in overheads. Initially, it was in cost of sales as well. Cool. All right. Sounds great. So I think I was in operating expenses. So the whole point is looking at GP, they call it gross profit. And then after it, you look at all your operating expenses. Basically, most of these are usually sometimes fixed. So for example, rent is fixed. It means that's usually annually the same amount every single year, or monthly the same amount. Software can be fixed as well. Accounting and legal is fixed. Travel insurance is fixed, and other admin is probably most likely, like if you throw a stab at it, 5K a year, you're most likely going to spend that amount. However, these ones here are more variable. It just depends on, who you need. And if your business grows more, then you most likely will increase this. It's important to know the difference between variable cost and fixed cost. The reason being is because it helps you budget. So at the end of the year, or at the start of the financial year, before 2024 starts, I might just go, all right, let's produce a budget. And then I would then go, all right, well, I want to increase by, times this by 50%, for example. So therefore, I want to go up to 900K. So how much? And then you start running the numbers, then going, okay, well, how many jobs do I need to do to be able to make this? And you can just work on variable, if you want to be just having a stab over it and just working out a solution of being able to figure out how much you should spend on things, you need data to be able to do that. So the more years that you're in business, the more information you get. And from all the information you're getting, as well as the research that you're doing online and speaking to colleagues, you start deciding, okay, well, what variables or what things do I need to take in mind for me to make that 900K? So for example, the last few years, I spent 150K, which is 25%, for contractor payments. So most likely, and I spent the same amount last year. So most likely, because of that data that I've got, I can now make a decision. Okay, maybe I'll budget 25% for this, for contractor payments. And same thing applies to these ones here. Okay. So you could do 2% for this. And then same thing applies. Okay, you're not going to get this right all the time. Okay, I just want to point that out. You're not always going to get this right the whole time. This formula doesn't always work, because what happened last year isn't the same as this year. These expenses might go up, and the growth, the original data that we had of 25% of contractor payments versus your total turnover may not apply anymore. But that's where you chop and change. If you look at these numbers on a regular basis and you see that your expenses are rising, then you know that maybe you won't be able to hit the 900K, or there are issues in your business and you can deal with it on that point. And I'll go in more detail of that later. So, all right, so the same thing applies with these, but remember how I told you need to understand fixed and variable costs. So understanding fixed and variable costs, then you can actually determine what cost stays the same. So these ones here that I put in bold are the ones that most likely will stay the same. Okay, whether your business grows to 900K or not, because you got enough people to cover, enough space to cover for the people that are joining you. You also got enough software, and legal and accounting should technically stay the same next year. Might put a small percentage of increase just to cover it for,
cover for it. Same goes with insurance. You might put a small increase for next year. So you do, what I would do, which is maybe just bump it up by, inflation, and do the same thing for here. So this here, what we're doing right now, if I can finish this, and then travel, these are the variable costs. So you might go, all right, well, I am thinking for my decisions and for my planning, I've decided I'm going to hire an admin person or a junior accountant or junior recruiter. So therefore my salaries and wages is going to go up. And salaries and wages here actually include super. So I just want to point out super is not showing up here, but it's because it's included in here. Cool. And then marketing expenses. You know what? I'm going to be tripling that. I'm going to times that by 3 because I need to grow this. So in order for this to happen, I need to make sure I spend more money on my marketing. So I had this plan. I met up with a marketing agency and I decided I'm going to spend a lot more money on marketing. And as a result, I'm budgeting extra $30,000 on budget on marketing. So travel and client meetings, I've decided because I'm going to meet more clients, that's going to also go up as well. So as a result, this is how much I'm going to be spending. Okay, now I've done this. I've worked out my revenue. What have I essentially done, guys? I have worked out my forecast. This here is a budget forecast. And then now I've got my net profit. So I'm going to just pull that in. Nope, that formula's not working because ChatGPT is not smart enough to do formulas yet. So let me just do that minus this. So now my profit should go up immensely. Okay, so now I'm making money. But this is the part where a lot of business owners don't do, and a lot of accountants don't also do for their clients. What they should do now is now split this into monthly. Look at this on a monthly basis. So what you can do, you can put this in ChatGPT, you can split it into monthly, or you can just create, 12 months and then average it out or put it in seasonality. And then the next thing you should do is go into Xero or your accounting software. So this is a demo company that I'm on Xero for. And if you go into the profit and loss, you can actually open up your P&L. And then I track this every single month. This is what I do with my team, my managers. So I go to accounting, profit and loss, go to current financial year by month, and I check this current financial year by month. Okay, obviously not all the data is there because it's a demo company, but I'll check this against my P&L here that I've created, which is a forecast or budget forecast. And I'll compare, am I actually on the road to getting there? So, in order to get to 900K per month, I need to be doing divided by 12. $75,000. Okay, I'm definitely not there yet. So therefore I need to adjust. Say I'm in April right now and pretend that these numbers are all there and I'm doing $10,000 and my net profits are in losses, right? What does that mean? That means that I should really make a decision. And that decision now is reduce my costs because I'm not going to get there. I'm not going to make that 900K. So all that money that I've been spending on to try to make enough money to, grow my business and end up getting this profit, it's not going to happen. And the only way I can figure that out is if I track my numbers, understand my numbers in my P&L, and do a budget forecast at the start of the financial year, and then compare as we go and make decisions. I might decide that the person I hired that was on 60 grand was not the right person for me, so I should get rid of him. Sorry to say that. I make it sound like it's that easy to get rid of a person, but it's, or maybe I'm not training that person right and I need to train them better, or they're in the wrong position, or I need someone that's more experienced. So as a result, things that helps you start making decisions. Okay, so that's how you read your P&L, you prepare a budget forecast, and then you compare and monitor against how you're actually doing. So that requires you to actually know how to use Xero. It requires you to get up-to-date bookkeeping. And this is the missing step that a lot of business owners don't actually do to be able to go, all right, I want to make $1 million this year. How am I going to do that? And then how am I actually going? It's just a habit you need to do on a monthly basis or quarterly. You don't actually need to do it monthly. You can do it every 3 months as well. I do this all the time and I track it. So every 3 months, I'm like, oh, I need to hire another accountant. And if I do hire another accountant, I put the numbers back into here. I just add, in simple terms, I just add another $100,000 if the employees are worth 100K and go, all right, well, if I put 100K in, I need to boost this up by a certain percentage. Okay, does these numbers make sense? And then I track it for the next few months to see if it's doing well. Balance sheet is also very important. So the most simple way to explain what a balance sheet is, it's actually a snapshot of your business at one point of time. So what it's worth, how much assets it has, like what does it own versus who does it owe? And then that's the total. That's what the balance sheet is. So a lot of people get confused. They go, oh, well, is this what the business is worth? If I go to if I go to the market and I sell it, do I get this money? Unfortunately, no, because in your balance sheet, because we're just preparing simple balance sheet, not showing it to the whole world and not preparing it like general purpose financials, they call it, or general purpose balance sheet, you don't actually need to put in some of the assets that are sitting in here that are market value. So this is actually generally everything that you have at cost. So what you've purchased, like you bought office equipment for $10,000. You've got money in the bank account about $90,000, and you've got trade receivables of $50,000. However, if your office equipment that you've purchased might be worth a lot more on the market. So if you bought it for 10K, but technically it might be worth $15,000. You might have got a discount. So that's not going to show. So therefore, this balance sheet is not a good view of actually what your business is worth on the market, but it's just basically what it's worth costs usually for small businesses. Okay, there's some things that are missing also, which is some things that you can't actually value unless you get a expert opinion. So, for example, if you're running a gym, you can't value your customer membership. So your membership base and the number of members that you have it's called basically goodwill. If you were to sell that business, they want that. They want your member base and the recurring revenue, and that's not going to sit on your balance sheet. So therefore, your total assets showing 184,000 isn't really a accurate number of actually what your business is worth. So that's one thing that you need to be aware of, that a balance sheet just shows really a basic version of your assets. It's missing a lot of data when it comes to actual market value, but it's quite important as well. So that's kind of like a balance sheet. And then it's also got its liabilities, which gets deducted off your assets. So your total liabilities could be like, trade payables, super, ATO fees, ATO liabilities, as well as maybe, money that you've drawn out of the company or you need to pay to yourself, and most likely loans as well. So if you've got car loans, that's also a liability. Actually, I did a bit of a play with ChatGPT, and I asked ChatGPT to tell me what a balance sheet is in simple terms. And it basically said, balance sheet is like a house snapshot. Imagine your business is a house. The assets are everything that's valuable inside the house. And the liabilities is the mortgage or the credit card that you use to purchase assets within the house. And the equity is what's truly yours. So if you sold the house and its belongings and everything inside and then paid off your loan, the equity is what's left over. So that's how ChatGPT explained it. Total assets minus total liabilities minus equity should equal zero. That's the rule. Assets minus liabilities minus equity equals zero. That's how it works. Okay. One thing that you need to be clear of as well is the profit and loss and the balance sheet actually relate to each other. You'll see here, there's current year profit. And that current year profit also is showing here as well in your P&L. Okay. And the reason why they relate to each other is when you make money, the business makes money and the money hits the bank account of the company. And it's also showed as equity, like a retained profits, they call it. So that's why the P&L and the balance sheet is very, they relate to each other and they're very important. You need to have both. And that's why the banks usually ask for it. Okay, so I actually spent a lot of time explaining both these. I haven't went into too much detail of the balance sheet, but I want to say that this is really important for you to know. Okay, you don't learn this in school, and the unfortunate thing is I don't even know why you don't learn this enough. Like people should learn this. If you're running a business, they should do a course about it. And because the reason being is because when you want to do things in your business, you need this information. You need your balance sheet, your P&L, and you need to provide it to the bank. And no one tells you this when you first start up your business. And the reason why they need this, the banks, is because they look at this to determine if they can give you a loan. Yeah, so they look at all of this information, the balance sheet, the profit and loss, to be able to determine that they can give you a loan. Yes, they can look at your company tax return, but when you look at a company tax return, it's actually very basic and summarized. So they don't actually know what actually is in the P&L that actually determine because the profit and loss that you show in the tax return is actually different from the profit and loss that you show to the banks. Okay, why? Because you get all these different adjustments for taxes. You get accelerated depreciation. You get some expenses here that actually are not cash payments. Like you don't actually need to pay for those. And you haven't paid for them. So the banks add that back or add additional expenses back in, and they reduce your payments. Yeah. So a big example is your loans. So these loans here, they don't show up in your P&L because they show up in your balance sheet. But then with the bank is that if they lend you based on this 100K or 300K profit or 195K profit, they need to understand that they still got now about 50 grand worth of liabilities that the business owner needs to pay. So they got to be careful. Can they afford to pay this amount as well as pay back that loan that gets borrowed? So that's why a balance sheet is quite important. I won't go into specifics of the balance sheet because I'm short on time. But yeah, the balance sheet is just a snapshot of all your assets that show up here and the liabilities you have. And then one thing that you need to pay attention to as a business is this, your liabilities. They are the most important things. Obviously, looking at this is also nice. You can see it usually in your bank account. You'll see 90 grand and you're like, yeah, amazing. Okay. But the liabilities is really important. And as a small business, there was one more thing that's also important. This thing here, trade receivables. And I'll tell you guys why. Because there's something called cash is king, right? You guys have heard this term before. Cash flow is king, right? Cash flow is king. It's used everywhere. All these business gurus talk about cash flow is king, and it's actually really important. And cash is king mainly because trade receivables affects your P&L significantly. So this person here is on, let's just bring it back a bit and delete this and then delete all the adjustments I've made and show you what I mean by cash is king. You can actually show that to the banks or to everyone that you're making a profit, but your cash is not doing well. So for example, this business here made $195,000 in 2024, but and the business actually collected he's got $90,000 in the bank. But if that $90,000 is not it's not 90,000, it's actually $10,000. I'm going to adjust this a bit real quickly, and I'll show you why this matters so much. The banks actually look at this as well. So let's go back to this. So I've only made one change to this financial statement, and I actually think this business isn't as good anymore. Okay. So the change I did was that they didn't actually collect the full amount of the invoices. They're missing like $80,000 worth of invoices that hasn't been collected yet. So they've done the job. They've issued the invoice. They look like they're making money, which is here, $195,000. But they've got like trade receivables amount owing to them, $130K. So if I dive deeper into the trade receivables and I look at the trade receivable report. Trade receivable is basically, in fancy words, in an easier way to know, is basically people that owe you money, your customers that owe you money. So I've sent $130K worth of invoices out, and if I look at the trade receivables report and it says that it's 60 days overdue, my customers aren't paying me. That's a big problem. Okay, the reason why that's a big problem is if you go back to here is you've got current liabilities at $50,000, meaning that all your tax liabilities that you owe to the tax office plus customers or contractors suppliers that you had to pay, you have about a total of $50,000 you need to pay, but you don't have it in your bank. That's where cash flow is king, because people think that just because this P&L looks amazing, you can't actually afford to actually pay this. And that's the problem. You're actually going to have problems in the next few months because you haven't collected that money. You're not going to actually be able to survive in the next few months to meet the monthly salaries, the liabilities that you have to pay with the ATO. And this business is going to shit just because of the fact that they haven't managed their cash flow. So that's the most important thing for small businesses, I find, when it comes to looking at the balance sheet, is to look at the cash flow. So you can't tell that by just looking at your P&L. When you look at your P&L, you think it's good. But then when you look at your balance sheet, you realize that by understanding how cash works in the balance sheet and how much money is in your bank account, if we changed this and went back to originally, it was showing as $90,000. $90,000 was going to be able to pay off all my debt. And also, if I had any monthly salaries and monthly expenses, divide that by 12, I also could afford 20K per month as well. So therefore, my business is healthy. Okay, so that's the big difference of not understanding balance sheet and applying it to your P&L to just see if your cash flow is good. And that's the reason why cash is king. All right, the last thing I want to teach you guys is taxes. One thing that you need to understand about taxes, and this is where I'm going to bring these closer together, is I tried to get ChatGPT to do a good job of this, to explain taxes to me, to put in the taxes in here. But you see at the bottom of here, when you make 240K, there's a tax bill of usually about 25 or 30%. So if I do that divided by the net profit, it's about 25%. So that means that if you forecast or you're going to be making $195,000, you can go into your P&L and go, all right, how much money do I need to save to be able to afford to pay the tax at the end of the year? And that there is just literally this times 25%. So it's about $50,000. But during the year, you may have paid taxes already. So let's look into that. So when do you normally pay taxes during the year? You pay it in your business activity statements. So there's something called the BASs for clients. So we actually generate a business activity statement reconciliation that looks like this. So this is actually all your BASs for the whole year. And it's done monthly in this case. But this every quarter, we actually will report the income. So you got your total sales, which is here. You got your GST on your sales, your 1B, which is GST on your purchases, your wages tax, and then also they call them PAYG, which is your prepayment of income tax. Okay, this one's messy. I just wanted to show you a sample version of it that me and the guys in the accountants do. But I got ChatGPT to prepare one for you. So ChatGPT prepared a BAS rec. So throughout the year, we lodge business activity statements for you per quarter most of the time. And what they do is they lodge a total amount of 600K in sales, and then $54,000 is GST. Yep. So this here, you can see 600K, and this is 600K. Okay, this is a bit wrong how they done it, but look, let's not go into detail. If they showed 600K here in G1, and then it should technically be 55,000 here, because 550,000, because it should be net of GST. But let's ignore that. ChatGPT isn't the best at producing the BAS rec for me. What it also did then is throughout the year, I would have reported all this income and expenses in my zero. So we'll grab that information per quarter and we'll work out which one has GST and then report that to the government. And that's your GST on the purchases, which is your 1B. Also on top of that, because you've paid 180K worth of wages, there's also tax on that. So what the accountant or what you do in the zero is you report the tax, the withholding tax on your gross wages paid. So that's your PAYG, which is W2, and that gets reported to the government as well. So throughout the year, you pay taxes, but get this, you haven't paid income tax yet, right? So it's just GST on your sales, GST on your expenses. So that's 54,000 minus 6 grand. So 54,545 minus 6,820. So you've paid GST of this much, and then you've also paid wages tax of 41,000. So how much did you pay altogether? You paid about $88,000. So a lot of people, first-time business owners, go, I paid $88,000 in taxes. I should get a refund because that's so much taxes. But that little did I know that the money that they've actually collected for the tax office isn't even to do with your income tax. We haven't even calculated that yet. And we've calculated it here at $48,000. So what do you guys think happens? They pay that $48,000 when we lodge a tax return. So that's on top. So that's the part where a lot of people get caught out. When we do the BAS rec and we show that to the to the clients, they go, oh shoot, I haven't even covered for the taxes for throughout the year, the income tax. And when you first start your business, we don't actually know how much profit you make. You might end up with a loss at the end of the day, so there is no tax. So therefore, you got to be careful. You're paying your taxes throughout the quarters, your GST, your wages tax for your employees or yourself. But the last thing you haven't done is PAYG installments, which I got ChatGPT to produce a summary again. They produce the summary per quarter. So if you've been in business for more than a couple of years, over time, the ATO knows now that you're making a profit every single year. So therefore, they lodge something in your business activity statements. And if you've been in your second or third year in business, you'll know what it is. It's called PAYG income tax. Yeah, it's called, they call it 5A, PAYG income tax. And you probably have seen it. You sometimes see it in your personal name as well. So this is a BAS rec. This is the total sales, 600K. See how it says 600K? This is the GST, the 54K. And then there's the 1B GST, which is the GST on your purchases, and then the wages, and then the wages tax. So the total tax that every quarter that you're paying is 24 grand, 26 grand, 25 grand, and 25 grand. This here includes your prepayment of income tax. So I wanted to bring this to your attention is like when you first start off your business, this amount here never gets included because no one knows that you're making money. But then after the second year, third year, you start making money. What happens is that the ATO knows that you've made the money, so they make you prepay this. So I know some of you guys have actually asked me, well, what the heck is this PAYG thing? It's pretty much a prepayment of income tax. If you lodged in the previous year that you've made money, then most likely they're going to send you a quarterly PAYG in your business activity statement for your business. And what would happen is you pay up to 35K, and then your total BAS goes to 100K for the whole year. Then you've actually prepaid some of the income tax. How does that affect your profit and loss? If you paid $48,000, if your tax bill was $48,000 because of that 195K, and you've paid 35K throughout the year, that means you're left over with what? 48 minus 35, 13K. Hence why income tax payable in your balance sheet is $13,000. Your business activity statement doesn't always include your income tax if you don't prepay tax. So you need to prepay income tax here, and you don't ever do it in your first year because no one knows that you've made money. Maybe even your second year, you may have not made money, so you don't prepay it. But then after you lodge a tax return that you've showed profit and paid taxes, the ATO then starts making you prepay some taxes. And as a result, once you prepay some of these taxes, it offsets how much your tax bill is at the end of the year. And so therefore you don't pay as much, and it's only 13,000 as opposed to 48 because you prepaid it during the year. And that, my friend, is financial literacy and how it affects how everything is relatable. That's how BASes impact your profit and loss. That's how it affects your balance sheet. And that's how your net profit affects your income tax at the end of the day. And how does your cash, your trade receivables, money that doesn't actually get received, affect your business and the cash and your decisions. And by knowing all those, that's where you can make better decisions. If you understand how much tax you need to pay by the end of the financial year, how much you should prepay now, as well as how much money is sitting in the bank and how much you need to spend later on down the track, it makes you make better decisions. And so you don't go taking all the money out to buy investment property. You don't go, paying for an employee when you don't actually have the money to do that. Or you don't go, investing in an asset when you can't afford it. or it helps you also set KPIs to make sure that employee or that asset actually makes you money. The ATO decides to take money from you in advance based on the history of net revenue. Yes, 100%. So showing, basically, if you report that you made 119,000, I did a trick here. But if you, last year they reported 2023 taxes, right? And the income tax was 0 at that point of time. That's an error. Obviously they were supposed to pay taxes on it, and the tax was 25%. It's $29,000. So have you noticed that in the BASs here, they pay 35K this year. So in 2024, they pay 35K, and then the year before that, they pay 29. Okay, I purposely did that because I put it like a bump for inflation, or well, a bit of a small higher bump. Because what the tax office does is they look at what you paid last year and they bump it up a bit because of inflation and all that stuff. And then that's how they determine how much you should prepay every quarter, just so you know. So this person lodged his tax return, worked out that it was going to be 30 G's in taxes. As a result, the ATO the next year, which is 2024, started making them pay 8,750. Okay, that doesn't always happen. And the reason why it doesn't happen is because sometimes no one lodges their tax return on time. So therefore the ATO doesn't even know that you've made a profit for 2023. So when you're doing 2024, they won't tell you to prepay taxes because you haven't lodged your taxes at all. So they don't even know that you made profit. So the biggest issue of a business owner is that they don't actually, okay, great, I know how to look at these, but it's so much work to look at this. It takes a lot of effort. And I know because when it comes to personal training, it takes a lot of effort for me. And I know one of you guys are a personal trainer. So, so I can't stand it and I don't do it. So what I should give you guys are shortcuts, things that you need to think about that you need to do, just like personal training. So personal training, for example, is you just need to make sure you cut this out, sugar, cut sugar out of your diet, walk 10,000 steps. These are the easy things that you need to think about that if you just do every single day, you will 9 out of 10 of the times be healthy, or 90% of the time will be healthier than most people. So this is what I'm going to give you guys as well. So what do you need to know? Obviously, every dollar that comes in the bank account, I recommend having like 30% of that taken away and put it into a savings account for the business. So that's a thing that I reckon is really important for you. And the reason being is because, yeah, sure, that 600K is not all your profit. But if you take 180K out, have you noticed that 180K, and what I calculated before, I calculated the BAS tax bill was going to be about 100K. So it covers for your taxes. It covers for your super as well, 10% on that. So super would have been 10% on this. Oh, no, 12%, sorry. And also it covers for your leftover taxes, which is the 13K. And you'll have some money on top. So usually 30% is usually a good number. So what was that again? 100K here, that amount, plus the extra tax that you're paying here. And then you're left with 138. So you're always got some money on top. That's why 30% of your total sales usually is a good figure to keep. What else is a good figure? Here is really important. Remember how I said cash is king? 3 times your monthly expenses is a good idea too. So for example, keeping 3 times your monthly expenses in your cash at bank is a good idea. So what I mean by that is what you should do is you should add up your total expenses. It's $405,000 for the year. Divide that by 12, times it by 3, it's 100K. So you want to have 100K sitting in your bank. Okay, that's a good habit to have. Right now, this person's got 90K. I'm comfortable with 90K, 2 to 3 times, okay with that. But $10,000, nowhere near enough to be able to afford. But 3 times, you're very conservative. You're going to have enough money to, if something breaks in your business, you're still going to be okay. So that's how I see it. And usually that's 3 times. 3 times is a very conservative amount. You could probably do 2 times if you wanted to. I currently, at today's day, do 2 times. And it's just because I run my numbers really well. Another thing is making sure that your trade receivables is low. So your trade, if you send invoices out, so not for the gym guys, don't need to worry about this. But for the people that send invoices out, trade receivables is important. You don't want trade receivables to be more than 2 months of your income. So what do I mean by that? If you do your total income divided by 12, it's right now $50,000. So you're making about $50,000 a month. If your trade receivables is $100,000, that's scary because that means that it takes you 2 months to be able to receive that money. Okay, so there is a problem because your money is taking so long to get to you when you make that dollar. And if you're doing that, that means that you're paying for all these expenses and it's taking you 2 months for the money to actually come into your door. So the time value of money is really important. Yeah. So try to keep it usually 1 month, 1 to 2 months. For me, it's like 1 month or less. So I keep my trade receivables at month. And how do you keep it down? What you're supposed to do is make it easier for your clients to pay you. Obviously, I understand some businesses that work with the government. Well, the government's good now. They pay really fast. But some businesses, it takes longer for them to be paid. Especially if you work for Woolies, for example. They have like 60-day terms. So as a result, it takes them ages for them to be paid. But if you can do your best to try to reduce this as much as possible, then it's actually a good idea. Okay, so I think they're the main things. Obviously, always keep an eye on your current liabilities as well, making sure that your current liabilities doesn't surpass your cash or trade receivables. Like basically anything that you can convert into cash is also important. So your current liabilities is showing $100,000, then you got a big issue. And sometimes your current liabilities does show $100,000 compared to here. And I'll tell you why. It's because you've got something called director's loan in here and you've taken the money out. So that's a scary thing as well. Or you owe the director or you owe someone money. So you've taken all this money out of the company, or the company owes you that money, or you've like borrowed money. And so yes, you've got this money in the bank account and you're making profits, but the money's not, you don't have enough to pay for your current liabilities. And that's where it's a significant issue. They're the main things that you need to be careful of. As long as you track your numbers, do your bookkeeping, look over your, take 30% of your income, put it away, and then obviously look at your trade receivables and look at your cash at bank on a regular basis, then you're fine. You'll be pretty healthy. All right, that's pretty much it. I'll see you guys later.